Hello, good day, and welcome to the Jack Welch Management Institute's Entrepreneurship Roundtable, an evening with exceptional entrepreneurs webinar. Please note this call is being recorded. It is now my pleasure to turn the call over to Dr. Paulo Narciso. You may go ahead.
Good evening, everyone, and thank you for joining us today. The only thing I'll correct from Jeremy's introduction is this thing about exceptional entrepreneurs. No such thing. Entrepreneurs, as you know, succeed and fail all the time. And it's exceptional when you're in the game. That's the most important part of it. So today I am very, very pleased to have two guests who are going to be joining me as we discuss the journey of entrepreneurship and all of the struggles and the issues that we face when we look at entrepreneurship as a whole. I'd like to introduce first Rakesh Sharma, who's a graduate in 2023. He also holds a master's in financial engineering from WorldQuant and is a graduate of the Indian Institute of Management's Executive Program in Business Management. He currently serves as a venture partner for Transform VC and VU Venture Partners. He also hosts a ton of networking events in Dubai, where he is joining us today, and he'll give us a really great perspective on funding and the VC world, and a different perspective between regions, because we're global. We're not just here. We have global students, not just students in the United States. So welcome, Rakesh, and thanks for joining. Also joining us is Gerald Tomlinson. Gerald's joining us much closer in North Carolina, and he's a graduate in 2022. He is the CEO and founder of an independent comic book producer called Ronin Entertainment, which is his passion. And he discovered his love for comics as an undergrad at East Carolina University, and he's followed that passion. And it's a great story about entrepreneurship, following your passion and turning that into a business. Actually, both Rakesh and Gerald have a passion for our field, and therefore have glad to talk about their journeys today with all of you. From a format perspective, I'll be asking some questions. I might be answering some questions or giving my perspective as well. But then we'll open it up for questions to the audience as we get closer towards the top of the hour, probably around 7:35 or so, to give us time to be able to answer your questions in the audience. So welcome, Gerald and Rakesh. Thank you so much for joining us and taking this time. I'll start with you, Gerald. Tell me about your journey. Tell me about why you decided to start Ronin Entertainment. Tell us a little bit about the business.
Well, I want to credit you first for planting the seed. It was in your class where I first thought of running entertainment as more than just a side hustle. At first, I just thought it was just something I would do on the side besides a traditional job. But while I was in your class, it was where I got the perspective that I can turn this into a business. And you also wanted to learn about the like what the business is like right now, if I'm correct. Well, Running's just a startup. It's very, very year one. Right now, I'm trying to get my first book started. Producing the art, that's a process. And right now, it's just a matter of like getting it ready for a Kickstarter, which is where the funding part start. And then after that, that's when we can really like rock and roll and like get more projects off the ground.
Awesome. That's great. I'll go back to you a little bit more about some of the things you learned in the program. Rakesh, yours take a totally different path. You are taking the path of enabling all of this from a venture capital perspective, and you also do it with an impact fund, which is something I'd love for you to talk about, and really both about why you decided to do that, and then talk a little bit about what an impact fund is.
Sure.
First of all, thank you for arranging the session and having us in this webinar. It's always great to connect with the large audience of JWMI, and I would like to share uh, my feelings and experience of this journey. So, to answer this question, venture capital happened to be a very accidental thing for me because I was at a corporate level, and what I really do for a living is like I'm a machine learning and computer science background guy. So sort of the cutting edge technologies like AI, machine learning stuff. That's what I do for the telco with which I work here in Dubai. And at the beginning of last year, I came in touch with a friend of mine over network, and he was in US and he was doing this investment and everything. So I just had a chat with him, and then he told that yeah, I'm doing this program, and then it gets me acquainted with startups, and I'm understanding their journey. So if I find something interesting, I put money. So then what was that? It was a boot camp in San Francisco, and it's a venture capital boot camp. So then I applied for it. I was thinking like maybe I'll not get into it, but then I checked with Professor Paulo here, and then he said like it's going to be really tough. You being in Dubai, you have to travel to San Francisco 2 weeks, and then you'll have to do this remotely. It's going to be really challenging because it's a boot camp. So then it was as Professor advised, and it was very challenging because of the odd hours and because you get in a lot of calls with startups. It's like a rush. It's like a hustle. So that 8 weeks of time that actually changed my perspective as to hey, I like this stuff. I'm in tech. I know what's going to happen in tech because you're at the edge of the future as a venture capitalist. You really see what a company is today and where it actually integrates in the ecosystem 10 years from now, when it actually going to IPO or go public, as we say. So that got me excited. And then I got sort of addicted to this process. So from VU, what happened is then I came in touch with a Dubai based venture fund. They were based in Dubai, both of the entrepreneurs. They had a very big entrepreneur success in Dubai, and then they launched their fund in San Francisco. And then they liked me, and then they said, hey, why don't you join us for LP relations? Because you're based in Dubai, you also have a network in India, and you also have your friends and network in North America. So I started working for them. So I started meeting people, their investors in Dubai, because most of the funders are from Dubai. And yeah, so that's how it happened. It was very accidental for me, but I like this journey. And then I've decided that I'm going to start a venture fund of mine. So during this whole period, I came in touch with a lot of other friends of mine who were interested in what I'm doing. So because venture capital was very elusive uh, for people like me, or I always thought like it's not something which you can get into easily, and it is not. And that's where Professor asked about the question of impact. So for me, I think any ordinary person cannot go get into venture capital because there's always a sort of you know somebody from this B school or somebody with access to this network are doing venture capital. And maybe people founders also do not have access to the right kind of venture capital at many point of time. And that's where the vision of impact within Fansome VC attracted me. And they were actually doing venture capital for people who are not in the valley, Silicon Valley. Actually, venture capital needs to go outside Silicon Valley because great ideas can come from anybody. That's what Jack Welch used to say. That's what we learned in JWMI. Great idea can come from anybody. There are great talents outside, so you need to really have an eye for what is that, and find them and help them or enable them to get to their entrepreneurial success. So here the motto within Fansome VC is like support the underdog, and I really love their motto, really, to be honest, because I believe I'm an underdog. Everybody at one point of time were underdogs before they really become successful. So this is what I love about this job.
Yeah, that's great. And both of you, that's a thank you for sharing your journeys, your startup journeys. And it's interesting. I actually heard somebody say last week um, about if you're always hiring the same talent from the same places, or you're always making investments with the same people coming from the same places, um, then you'll technically get always the same result,
Same.
right? So if you want to do something transformational, you got to go outside of that and look for unconventional talent and unconventional ventures from everywhere. So thank you both for being examples of that and the work that you do. Gerald, as as you decided to take the path to be an entrepreneur and start a business, tell me about what was the barrier? What did you feel was a barrier for you before you start, or you probably still, even if you still potentially even experience that barrier today? Talk a little bit about the barriers that were in your way, and then maybe we can have a discussion about how we might be able to overcome those.
Okay. Two big ones, knowledge and capital, lack of capital. Knowledge, I was someone who had a passion for comic books, but you'll notice like a lot of people in the mainstream industry, they've read comic books, they've designed them, they've been a part of the industry in one capacity or another. And that was something that I had just like found as an adult. They had been around it like since they were children. But it's something that I was a little late to the party with, and I had to reach out to people to learn a bit more about how I could like enter into the industry, at least from an indie standpoint. As far as like just being an entrepreneur, entrepreneurship is something that you cannot do alone. Even if you're just starting out as a sole proprietor, you might have to consider getting a mentor, which is something I've done. Someone who could teach me how to navigate the steps of being a business owner. Because as I told you yesterday, being a business owner is like being a modern day pioneer. You're going into uncharted territory, and you'll never know where you're going to end up. But as far as like capital, I mean, that speaks for itself. We're all trying to get money for our business while it's in operation. After it's reached its highest point, but when you're starting out, sometimes you have this grand vision for your business, but you don't have the capital to compensate for it. So that might hinder some things. But yeah, that's how those two obstacles kind of hinder me in a way.
Yeah, that's great. That's spot on. I mean, those are always the things we worry about. Do we have enough? Do we know enough? And then do we have enough to be able to make sure this works? And I always say that an entrepreneur really has, you can debate it, could be three or four things, but one is having the vision. You got to first build that vision, whatever it is. Second thing is you got to build a team. So like you said, you never do this alone. At the end of the day, there's always a team behind you, even as a sole proprietor. In many cases, there are people behind you that are helping you get through and getting you to where you need to go. And then the last least, you've got to raise capital, and then you got to do it all over again, because that's how you keep the machine going, and you keep the vision going, is by making sure you have the resources to kind of get to the next step. And the resources could be anything. I mean, for some people, it's millions of dollars. For some people, it's just thousands of dollars. So it depends on kind of where you are and start. We'll talk a little bit about kind of startup strategy and funding strategy in a second. I'm going to do a follow-up question, Gerald, now, when did you know it was the right time to do this, right? We talk about that in class. Jack always talks about it. I mean, he wrote about when is the right time, right, to do this. His answer was now, right? There's never it's always the right time to be able to do this. But how did you know it was the right time to be able to kind of make that leap?
It's kind of in a way like Jack Welch said, you're not getting any younger. I mean, how many degrees are you going to get before you start this business, man? You got two of them. It's time to like, put up or shut up. So it was a now kind of thing, just you have the knowledge, so just give it a try. If you have to get help, you have to get help. That's just how it is. But at least like don't try, do. That's how
And
it worked for
is this
me.
the first one you've done, right? This is the first venture that you've launched, correct?
Yes, sir.
Okay, good. And was there anything that was holding you back from doing things in the past? Was it just the time? What was holding you back from?
Admittedly, fear. It's one of those things where you're worried about what happens if I fail? What will people say if I fail? Just to be like transparent, it's one of those things where, I mean, it sounds silly when you actually get out there and start doing things, but it's something that holds a lot of people back because a lot of people are afraid of change. A lot of people are afraid of failure. That was what I was kind of afraid of when I first started, but as I got knowledge or while being in your class, it was just like I said, I had that moment where you're not getting any younger. You have 2 degrees now. Let's start using them.
Just to be clear, I never wrote that in any DQ or any assessment to say you're not getting any younger. Stayed out of that completely. And Rakesh, when you think about it from your perspective as doing venture capital work, I'm going to turn the question around a little bit because you meet with a lot of entrepreneurs, you see a lot of plans. When do you know that the team, the team that you're funding, the entrepreneurs that you're funding are ready? Well, like what gives you that? Okay, yeah, they're these are the guys or these are the women, the team that I want to be able to put a bet on.
Yeah, one is that's a great question. So basically, I look for basically the passion, what sort of background they come from, and whether they can actually do that, whatever they are thinking they can do. So basically, a healthcare guy uh, talking about rocket science doesn't make sense at all. So a healthcare guy should talk about innovation in healthcare, whether using AI or something. So basically, I look for the 4 pillars which actually Jack Welch taught us. Like one is like energy, and ability to energize, having that edge and and passion and ability to execute. Ability to execute, you never know, but then you always think in terms of because you're talking to them at an early stage, but you always look for what sort of milestones they can hit, and that is very important. Because we do a seed, most of the funds which I work with or transform we do a seed or early stage. And at early stage, there is not much of a data which you can look into to analyze the company, hey, whether they are doing good. But what really we look for is whether these guys can, fail and can iterate and change the idea, whether they are able to listen. It's good to be confident with your ideas, but you also need to know like what sort of risks you're taking and whether how to actually overcome that risk. And we try to bring in that value by connecting them to other people. Say if they are having challenges with respect to go to market, we can find people from our own team or our own network connectors to get somebody who can actually push that and do that for them. We have done that before. So I really look for those factors, and that's when we know we build that conviction as to yeah. And procedure-wise, there is a lot of sort of 8 cornerstones that we look for in terms of how this idea is going to take off. So basically, network effect, differentiations, a lot of network effects we actually think in terms of whether this can happen, whether that can happen. So that sort of analysis there. But when I see a founders, I look for these things, and that's a vibe, that's the initial connect which happens in the call, and then that's where we actually do further due diligence with our team.
Right.
If it answers your question.
Thank you for that. Um, how has your journey or how has the program at JWMI helped you prepare for where you are today? I'll open that up to Gerald first.
Well, as I said, your class planted the seed, but there were other classes that I took beforehand. I remember taking my first class, Mr. Dr. Gary Bodum's. It was a class, I believe, in leadership. And one thing I learned there is it sounds very rudimentary, but sometimes it happens in the business world. Do not become the reason why your business fails as a leader, because as an African proverb says, fishes rot from the head down. So um, that's one of the most prominent lessons I learned from that class. We studied a case study about a board of directors at a company. I can't remember the company exactly, but there was infighting among the leaders of that group, and it eventually spilled over into the company's performance. It affected it, and well, I mean, it just created a big mess. So that's something I've learned from Jack Welch, the Jack Welch Management Program. If if you're a leader, please try not to be the person who ruins your company or ruins your dream, because your business is your dream in a way.
That's great. So thank you for reminding us of that. Entrepreneurship and leadership are joined at the hip. You can't separate the two. You can't be a great entrepreneur unless you lead, and you can and you have a team that follows you. are willing to be able to execute to that particular vision. So it's a great reminder for all of us. Rakesh, I'll turn the question to you, and I know it's a different path, for you in finance and so forth. But talk to me about what you've learned in the program and how you've been able to apply that.
I think the biggest change, I think I would say like my mindset changed completely after doing the program. So you teach a lot of mindsets as growth mindset and entrepreneurial mindset and everything. But there is one thing which has changed in me and which on reflection, I feel that there's a mindset called producer or doer mindset, and there's something called there's a mindset called consumer or the doer, and there's a mindset called producer, right, or doing for others. So that is what actually would say like a clinching thing for me. And I was really wondering, okay, what I'm going to do 10 years from now, or where I want to see 10 years from now. So I was like, okay, you can be head of data or chief data officer in some corporate company. Is that what you want? I said no, maybe not. So then what else? Then I think I eliminated many options that way. Do you want your own startup? Yeah, but is there anything better which you want? So venture capital looked like an ideal thing for me because you can live the life of multiple entrepreneurs. Because it's just not about writing checks and vetting that deal. It's also about really being in their shoes and really thinking for them what they're not able to. Because it's not easy. Entrepreneurial journey is not easy. I know what Gerald goes through when kind of challenges which they actually face at different stages. You make it, but you fake it till you make it. I mean, it's Sam Altman comes to the screen and says, yeah. I mean, he makes big statement, but it's not. I know the kind of insecurity and kind of confidence battles he is having inside, with respect to all sort of pressures of the board and the demands of the investors, demands of the workers, employees under him. It's not that easy. So I think being a venture capitalist, you actually think in their shoes and you have the ability to actually think about multiple sectors and multiple companies and think about operations, think about innovation, growth, finance at the same time. And it's highly dynamic nature of the job. It's one day you're talking to somebody, next day you're traveling. So you always need to be at your feet. And basically, if you're not running your own fund, I report to my GP. So they have a lot of demands, which happens over Slack channel or WhatsApp. Okay, hey, I need to analyze this particular thing, and it has to be very quick. So essentially, this job is about making decisions, and you're enabling your partners, your GPs, your founders, your investors to make that decision. They are entrusted, or they are trusting you to make those decisions for them, and that's a great prerogative, I would say, or privilege, and which I don't think any other job will have. And that's the reason why I don't see it as a job. I see it as something sort of a vehicle to change a lot of stuff, like founders, the climate of investment, and all that. So it's a vehicle for change. I would say that.
That's great. So, one of the things that many people encounter when they're starting a business is they can't just start a business. They can't just quit their job and then start working, or start that business. They need the income, coming in. Do you have, and I know we talked about this prior to this session. And I know in Dubai, it's very common for people to kind of have a job and also do something else, and it's widely accepted there culturally and business professionally. Sometimes in parts of the U.S., it's not, right? It sometimes it gets frowned upon in parts of the U.S. But um, Gerald, when you started this, did you just decide, okay, I'm quitting and I'm going to go ahead and just do this Ronin entertainment, or how did you balance that out? Did you have to keep your current job and make that think about the transition later? Any tips that you can share for the audience?
I would say as a tip, I would say keep your job because it's always good to have a supplementary income in case. I wouldn't just jump out and quit, unless you're at that point where I just can't take it anymore. I got to get out of here. But everybody's story is different. Everybody's situation is different. So I'm just going to give my perspective. It's not really a tip. I would say if you can help it, keep your job. because like I said, two incomes is better than one. You can always use your traditional job to feed into your business. Um, but like I said, you should take a moment and always evaluate what's best for me or what's best for where I am, depending on if you want to be an entrepreneur or not before you make a decision. That's what I think.
That's an excellent point. Everyone's in their different journey. Right? There is no formula that says this is when you do it. This is when you quit your job and you go all in. You're always all in when you start a new venture anyway, because you're putting so much of your time and energy. But you have to evaluate that yourself. There is no magic formula for for doing it. For some people, it's jumping off the cliff is fine, right? That is where they are. But everyone has to kind of examine that, and there is no wrong or right approach to be able to do it. Rakesh, from your perspective, when you are looking at the deals that you're working on now, is that something that's being evaluated? Are they working for a different company? Like, where are they in the startup stage?
Not really. We don't look whether they are, but I think most of the progress are made by people who are all in, and that we see as a difference. So because I am at the stage where I have some sort of financial independence, so I can really think about, okay, shall I go in this path or should I start a venture? So I think over a period of time, I think even before an entrepreneurial journey, I think there has to be a little bit of groundwork which you need to do, which is like you build your network. You need to really have a list of people in your connection whom you can actually depend on, for raising funds. You need to do that homework even before starting any entrepreneurial journey or venture fund. Like you really need to have the opportunity list of what is the opportunity value of this particular network, and that's what we do in before starting a venture fund. What's your network? What's the closest network you have? What's the value of fund? We're not analyzing people by money, but you really need to ask and raise money at the end of the day. So we look at that, and so before starting a venture fund, it's like a 2-year effort of pre-built phase wherein you build enough connection to the founders, ecosystem, entrepreneurs, and investors. Similarly, I think entrepreneurial journey is also like that, and there has to be some sort of a groundwork done. So that's why like you have these accelerators like Y Combinator, Techstars, etc., where they help you with the seed money, and they also help you with taking you to a stage where venture capital can come and invest in, because the MVP or the minimum viable product or the proof of concept is very important, because you need to have something when you actually go and start pitching at people. And even in seed stage, unless and until it's bootstrapped with your friends or family money or whatever, or your personal income, when it comes to seed and startup stage, there has to be some sort of attraction in terms of, okay, we have grown these many customers, we have got these many people to sign in. So that is important. So even though we don't look for whether a guy is doing this job or he's doing multiple jobs, but in order to get that traction, they need to have foundation laid as to who's what in this company, whether there's a CEO, CFO, or COO. I mean, that has to be clearly defined, whether you have a team, because we're taking bets. Because for you, if we take a bet at you, then we are losing an opportunity of taking a bet at somebody else. So we're thinking in bets actually, or which bet is going to give us maximum returns like 100x. So that's the thinking for venture capitalists. If you empathize with them, it's also not easy for them, because out of the 30, 40 investments which they do, it's just 2 investments which actually take them to that level to give a return or a multiple of invested capital of 10x, making everybody happy at the end of the day.
Yeah, no, that's right, and it's different in terms of stage of where your company is, and when you start looking for investment. It's actually a question that we have from the audience is around, like, when do you start thinking about actually raising external funding, right? There's different stages of funding. And if you're going through kind of a venture back kind of round, you are in the pre-seed stage. I'll start earlier. In the first part, you're in friends and family stage. That is when you are having your friends and family literally contribute to be able to help you get your idea off the ground. And then you move even from that into pre-seed stage. We're now working to probably with angels or maybe even with accelerators and incubators to be able to help you get your product um, out to the market tested and a real MVP built that you can start thinking about what the market that the product market fit would look like, and is there any evidence that you're having product market fit? And then you go in through seed stage at that particular point. Once that is established, where you're starting to now think, okay, is there evidence for scale? And that's when I'll normally look at seed is well, there's evidence that the product works in the market. There are customers who want it. Let me now look to see, can this actually scale? And then we're looking now at kind of the scalability. Then you get much larger from there into the A rounds and future rounds that you look for. When Gerald, from your perspective, have you gone through any of kind of those particular rounds, or when do you think it's right for you to actually start looking for money outside of kind of friends and family?
Well, as practical as it sounds, when you run out of friends and family to ask. But I think when you've gotten to, as Rakesh said, when you've gotten to a point where you've built a grand vision, you've got a foundation, and you've proven that what I'm selling works, people want it, I have a demand. I think that's when you should probably like look up maybe angel investors, outside people. I personally, in my industry, what we do to raise money is mostly crowdfunding. It's basically Kickstarters, putting our work online so people can see it, and basically like they act as benefactors. They fund our projects for us. Um, I've also been in rooms with angel investors, got a lot of rejection letters, but it is what it is because I sell comics. A guy who sells the latest form of cyber security or technology like that, he's gonna get the look before I do. I mean, it's just the industry. I don't take it personally, but it's just the industry.
Yeah, it's a great attitude to have. It depends on where you are, and doing things on Kickstarter and the other crowdfunding platforms is a great way to be able to do it. It's actually um, a very common way, particularly for creative ventures, to be able to go through those particular platforms. So the story there or the moral there is depends. It depends on what it is you're trying to do, and then find the tribe or the platform that enables that. For creatives, it is a lot of things on Kickstarter and Indiegogo or things of that nature, which are very helpful, especially for products that are direct to consumer products or kind of B2C product versus a B2B product, for instance, which will have a little different. Rakesh, in your experience, what are the types of companies that you invest in, and where are they in terms of their investment journey?
Okay, so basically, investment type depends on the investment thesis of the firm. So both the firm have worked with our deep tech firms, which means deep tech. What I mean is like not just computer-based technology, but other things like earth sciences, new material, healthcare. So wherever deep tech comes in, because using deep tech, you can actually solve a lot of things. And with accelerated computing power, which we have today, and machine learning and all those stuff, a lot of data around, a lot of what do you call this, push or development happening in these areas. So deep tech in healthcare and everything, and in particular because we are an impact fund, we're looking at social climate effects as well as infrastructure, deep infrastructure. So these are the areas which we are investing in. So we are looking at new materials which can actually take carbon or environmental effects or environmental pollution or negative effects of environment can take which can take that away. And we're looking at AI-based tech in healthcare which can actually solve problems. An interesting one is a company called Control Line, which is like male contraceptives, which was not talked about before. It was more or less like invasive female contraceptive procedures, but we focused on male contraceptives now, and which is like non-invasive, using chemicals which doesn't create any effects. So all sort of futuristic concepts. The other area I think which is heavily focused on is on deep tech, especially deep tech for coming up with new molecules for medicines. CRISPR is taking off, and it's really I think it's going in a different level than we thought before. So most of these innovative ideas are coming from universities and research institutes, and that's where Transform VC's primary investments are focused on. So the network ecosystem is also aligned with this sort of innovation which comes here. But VU venture partners, it's like we're also consumer focused. We're also in the sense like we might have fintech products, not within maybe geography of USA or Canada, because I think it might be an old idea. But I think since it's a open geography, or like we are geography agnostic sort of a venture fund, we are looking at these ideas coming from different markets like Nigeria, for example, UAE, for example. Tabby was a fintech investment which they invested in Dubai also. So different regions are in a different stage of development in terms of the economy, in terms of their growth, in terms of technology developments, etc. So for a geographic agnostic fund, the whole world is their market. But for a specific fund like Transformation, which is investing only in US, Canada market, for them, I think they might be looking at real niche areas, especially with impact theme around. So it ideally depends on, what sort of impact thesis which you have, which is the core. Just like a vision for an entrepreneur, impact thesis is the driver for venture fund, and that drives almost all network connections. Even the LPs, we don't want LPs who are not aligned with our vision, because they cannot be convinced to write check for us.
Right.
It works that way.
Great. We're at 7:37, and what I want to do is open it up actually to the audience for any questions that and any. Let me just preface this by saying any question is fair game. There's a couple things we will not answer. We established that in the beginning of the session when we were all talking privately. We will not argue about barbecue. That's something we will not discuss in this particular show, and obviously we stay away from politics. As well. But we do, and religion. We'll stay away from those things. Aside from that, any questions, fair game. To me or to Gerald or Rakesh, we're and I'll moderate and figure out exactly who should be able to answer that question. But I'm going to take one question from Alonzo Wright, who asked, and he brought up a great point about Black founders in the U.S. The funding for Black funders raised only 0.48%, so less than 0.5% of all venture dollars in 2023 went to Black founders. Just a glaring statistic. Any ideas about what steps or initiatives would we recommend to be able to close that gap? And Rakesh, your perspective is probably different also with different populations in the Middle East and so forth. But love to get your perspectives on some ideas where we might be able to close that gap.
Sure. That's a great question, and thank you for bringing that up. One reason why I am associated with Transform VC is their vision for minority founders. So they actually invest in people within US, founders who have not got the attention from the traditional venture capital. We agree that there's a huge gap in venture capital. So venture capital is highly concentrated within certain places, especially the Valley, and the network is also within the Valley. People from certain grad schools and tech schools get access to funds easily. That's all true, and that's the reason why I think there's a strong push towards democratization of venture capital. And with institutions like Transform VC and others who really focused on the minority founders. Transform VC really focused on minority founders like Black founders, Latin American founders, Asians, or people from founders from Middle East. And they, as part of impact, they look for these metrics within the companies, which is founded by Black or minority founder. Second one is, do they employ people who belongs to the minority category? Minority doesn't just mean race, but it also includes gender. So Transform VC, if you look at half of the team in Transform VC are females. The partner is Rama, who's a female founder, accomplished entrepreneur, and she has managed fund. So these category of venture funds are called emerging fund managers. So they are the ones who have raised a fund before, and they're emerging because they're really focused on diversity, equity, and inclusion, which is something which we actually strongly advocate within JWMI also as part of the program, as well as the institutional value. Um, so these are the reasons why I think these funds are treated as emerging fund or emerging fund managers, and they are the real ones which is going to change the game of this gap existing in the industry. So that thing is coming. Right now, there are a lot of funds which is actually entirely focused on Black founders, Latin American founders. So that's really coming up. These might be small funds, but sooner or later, I think we're gonna that gap is gonna be bridged. I'm not gonna say it's gonna get eliminated completely because I think these differences, cultural differences, has been existing for generations, and it'll take time. But that gap is gonna brought to be, and it's gonna be brought down. And there is an effort, strong effort from everywhere. And even the big institutions also realize that there is value in investing emerging fund managers. There's value in investing in minority funds because we see more growth there because they are strongly focused on people, and we are not just writing checks for the sake of writing checks. So they're really focused on values and how we can actually enable that growth. So that focus comes in with such funds.
Great. And Gerald, I'm gonna kind of twist that question a bit more and not just turn it around, but twist it. You're a Black founder, but you're also doing comics, right? Which is, I'm not very familiar with the industry, but are there any challenges there, right, that you see, and anything that you want to share with us around around kind of the issues you're seeing from a funding perspective?
Um, I wouldn't say from a funding perspective. It's more like if I would say, being accepted by audiences, like consumer reaction. Um, I think the challenge for Black comic book creators is when you try to like write a story that you market as a Black creator, you have to also walk this like tightrope. You have to wonder, like, am I just making this for like other Black people or Black creators, or am I going to try to like branch out and try to get the whole pie of who I could get for, as far as who would might be interested in what I'm
Audience,
producing.
right? Yeah.
So it's a challenging type of tightrope. You have to like really take a moment and think about like, who do I want my target audience to be? That I think that would help a lot of Black creators, because sometimes you have to understand, sometimes everybody doesn't like everything. Culture is different for different people. What you think should resonate with people doesn't. Um, so it's a very subjective thing. Subjective medium comic books is. So I think that's like I said, it's a tightrope every Black creator has to walk in a way.
Great. Lots of questions from the audience. And by the way, if the audience want to ask a question and then actually just raise your hand, I'll open up the mic so you can ask the question directly. But do have quite a bit in the Q&A on chat. I'm trying to pick things that we haven't discussed yet. And this one is a question that I get all the time, and it's about actually, how do you find a VC, right? How do you get their interest? That is a question that Sean O'Hara asked. I've twisted the question a little bit and paraphrased it. But how do you know that how do you first of all find a VC that, and second of all, it's how do you know if a potential investment is worth your time to listen to their pitch? Rakesh, I'm going to ask that question
Okay.
directly. Yeah.
So finding a VC, I think just network, just go to the right network. So, say for example, in Dubai, also a lot of founders events happen. So there's a group who actually conduct founder events. So you can actually come to that founder event. So a VC might be there in founder event who might be conducting a session, or enablers of VC, or people running accelerator platforms or incubators might be there, and that's where you actually get to know the people, and then they VCs would come there. So you can actually directly network, or they might actually give their email or some LinkedIn contact, and that's how you get in touch with um, VC. So you'll have to really go to this founder event. So normally, I think I had when I during my journey when I had to network, I had to go to this boot camp. So before that, I had zero VC connections. So till that point of time, I don't have any VC. I was never knowing what VC is. Didn't know the vocabulary of venture capital world. But once I went there, then I found out many. I mean, they were because VC culture is different. They are ready to introduce you to people if they find something good in you, because they don't have time. They actually are adding value in every interaction. That's what they look at adding value, sharing value in every interaction they do. So if you go to such groups, you naturally would find VCs. You go to a founders event or founders group, you would have somebody or the other who connect to answer the second question. How do you identify whether a pitch is so? The two ventures fund which I worked with, one is like the first one really relies on the conviction of the person or the VC associate who actually gets in touch with the founder. So even before getting the pitch deck, we actually meet the founder. Maybe they look at the background, what sort of a industry or that founder comes from, what they are pitching for, what's their idea. Once they listen to that, they make their conviction, and that's the VCs are supposed to have that conviction and that um, belief and confidence in them, because we live at the edge. Because VCs do when they are not really writing checks and talking to the founders, they do a lot of research in terms of where the industry is, where the industry is heading, what's the newest or latest development which has happened in that industry. So VCs would naturally want something to be at the edge, so that because they're saying like, okay, next 10 years where this is gonna be, right? They're always making the judgment of next 10 years where this is gonna be. So they're really thinking in terms of competition, economic moat, lot of this differentiation, product market fit, founder product fit, team product fit, and everything. So they are thinking in these terms always. So a lot of thinking goes in. So VCs know actually when they actually see a pitch. So they might, if they are interested, they might actually ask for a further session with you. So first talk is just quick session, understanding the founder, whether that edge is there within the founder, whether there's conviction, initial conviction, and then a detailed discussion happen. That's when they do the due diligence. So this meeting can go like 3-4 times, and before they actually finally bring it up to investment committee. So that's a normal process. You first meet the founder, get their deck, understand, then go back and forth in a couple of other meetings, understand what sort of a funding you're trying to do, who are the other funders. Some VC funds actually look for lead investors, which means you already should have a lead investor, and then only I can come in. I might not take lead in this round. And they also look at what sort of a share they're going to get. So there's something called capitalization table, where it tells you what share each investor has got, and they might want to take a look at it, where my money is going to be put into, how it's going to convert it to price per share, and what is going to be its value in the future. So all these things comes into place. A lot of calculations goes in. And finally, they bring this to the investment committee. And after investment committee's pitch, still they go through a lot of other discussions before they actually make. So it's also not about the idea and the company. It's also about where that company stands with rest of the portfolio. So a VC fund might invest in, say, 40, 50 companies. And they actually want that synergy to be there within the rest of the portfolio companies. Say you're investing in a company called energy or battery energy storage solution, and they might be having a company which is doing electric cars or self-driving cars, and maybe they think that okay, then there's some sort of synergy, we can actually help each other grow, because that is very important. Because at the end of the day, VCs know for sure that not every company is going to go and hit that mark, and they know that 95% of the companies are going to fail. They know this for a fact, because that's the statistics. Out of the 100 companies, I think only 2 companies really goes to that level. So they really think in terms of bets, and that's where you need to get the attention of the VC, like what they want, what sort of investment thesis they have got. So before a founder comes to VC, really go and check whether what sort of investment they have done before, what sort of value I'm going to get from approaching this VC. Maybe this not this VC, some other VC should help. So we also in VC world help other like we've got certain friendly VCs where we can actually bring a deal, which I can't do. I'll for sure help you connect to the other person who can help you better. So it's not just about writing checks, but it's really about adding that value and helping you grow. Otherwise, there's no point because just by writing check and going back home, we can't hope for growth.
Yep. Looks like we lost Gerald on the Zoom. A question also has come up a lot, which I see around how do we structure the deal, right? Am I giving away too much? What do you expect? I'll answer it from my perspective, obviously, in my world and what I've done. And you will get 50 different opinions on this one. So depending on who you ask. So nothing here is what I would consider to be sacred. And it's a mindset issue. The mindset issue is some people think that I would rather own, a quarter of a grape than, or I would rather own a quarter of a watermelon than the whole grape, right? So, because the value is there for you, you want that particular part. Some founders that I've worked with, even in the beginning, when I launched my companies, I did not want to give up any kind of equity whatsoever. My mindset had to shift depending on exactly, again, thinking about the resources you need to be able to achieve your vision and what that balance is. So I would, depends also on where you are in the stage of your company. The earlier you are, the more risk. And because there's more risk, people who invest want a bigger pie because it's just a risk reward kind of situation. So you have to consider that when you are raising your money, how you value it, and then how much you should package it. I also tell people that when you're raising money, it is all about prettying up your baby, right? It's a baby, and you want it to be the most attractive baby that's possible out there, and you want the deal to be as attractive it could be to the people who are to the venture to the venture capitalists that are looking at that particular deal. Because a venture capitalist has to make a decision about whether when they may love the idea, but if they can't make the deal work, right? Because it doesn't work financially for them, it's not going to happen. So you've got to think about how you package that completely so the baby is as pretty as it can possibly be, that you get it adopted. I hate to use that analogy, but that's really kind of how you think about it from a mindset perspective. But there are those who think, no, I'm not giving up more than 5% of my company ever, and they go through that particular stage. And you just have to figure out what works. When you have very strong IP, for instance, or you're at a different stage where you're already scaling, I get the 5%, I get the 2.5%, the small numbers, but it just depends on where you are, and from in terms of your company's journey. Rakesh or Gerald, anything to add to that particular question and my response?
Yeah, I mean, what you said is right, but that's one thing which we all, as VC also think that we actually want enough room to be left to raise funds in the further rounds, and that's a company growth because we come at the seed stage, early seed A stage, and maximum share which we go for like 15%. That's a max because we write a check up to 1 million, and we take max of 15% share. So one thing which we keep in mind is that it's not about getting the maximum of the pie, but you should have enough room for founder to be motivated enough and other investors to come in later stage. That's the company is going to grow. even though even I'm going to retain the pro rata rights to invest further. But we really want other VC funds to take it further, because the value which other funds bring in is different from what we do, because we come at Series A, and we need different values to come. So that has to be still attractive for others. So that's how we think. And you're right that we need to have. It's not about winning, win-win for it has to be win-win and not win all for one party.
Yeah, great. We are close to time, so if anybody wants to ask a question that hopefully we haven't that I haven't missed, or want to ask a question by raising their hand, feel free to do so. It's been great listening to Gerald and Rakesh. I've learned so much over the last hour. Thank you so much for sharing different perspectives and different parts of your journey, because it's all very different. And that's one of the things that we wanted to emphasize today is there is no, I'm at the D stage of the journey from A to Z. It is everyone's in a different spot. Even companies that are not startups anymore are in different spots. So these journeys are completely different. So we wanted to be able to share those journeys with the audience. And if there's no more questions, I want to thank again
Real quick,
everyone for attending, for giving us your time. I super appreciate it. Thank you for our guests tonight for again sharing their stories and giving us so much of their knowledge and their time, and for making this event happen. Hope everyone has a great night. Don't hesitate to reach out on LinkedIn to any one of us. We'll make sure people have the LinkedIn profiles. I think we put that in the invite, but maybe not. So we'll make sure that we have that. And this is a community. And so we want to make sure we support each other. And this is not a one-time event. We want to keep this discussion going. So feel free to be able to continue to discuss and reach out, and really appreciate everyone with the mindset to be able to do that moving forward. Have a good evening or morning, depending on where you are. And thank you for joining us this evening.